Morning and welcome to this session of GFAS Global Financial Accounting Standards. So, those of you who had attended the intro session, I had already told you in the intro session that those students who do not have much idea about accounting, it is better to get hold of one book, any accounting book, school level book, so that you will be acquainted with the ideas of the various aspects of accounting. Basic ideas, that's all. Other things we shall discuss during this course. But basic ideas you should have. If you don't have the basic ideas, you may find it slightly difficult to follow whatever we are going through in this course. So try to have some basic ideas about accounting, and for that you need not go and buy a very big book for that. I mean, you just have a simple book. You get hold of some school level book, that's all, and try to understand what this accounting is all about, and that will give you a base or a foundation for going through and learning whatever we are going to discuss in this course, which is called Global Accounting Standards, Global Financial Accounting Standards, GFAS. Now, as already I told you during the intro session, what is the necessity for having Global Financial Accounting Standards? In today's world, this is the world of globalization. Because it is the world of globalization, more and more companies are doing business and having business connections across the globe. They are having business not only in their own country, but also they have got business interests all over the world. Indian companies are doing business not only in India, but they have become multinational companies and are having business interests all over the world. Similarly, other foreign companies, they are doing business not only in their own country, but they are also having business interests all over the world. So in this background, it is very essential that the financial papers like balance sheet, profit and loss account, cash flow statement, all these financial statements of an entity should be prepared as per some accounting standards which is accepted worldwide. Otherwise, what is going to happen is that entity which is preparing its financial statements, those financial statements may not be acceptable in different parts of the world. As a result, they may find it difficult to do business globally. Hence, it is very essential that entities follow these accounting standards, and these accounting standards have now been accepted almost all over the world. Global Financial Accounting Standards. So that is what we are going to learn during this course. And those of you who have not joined the cloud group, I will request all of you to join the cloud group. It is very essential that you join the cloud group. I'll give you the details. Already I had given you during the intro session. The cloud group name is REV GNIIT S160883. That is the name of the cloud group. So all students should join the cloud group. Important information will be given in the cloud group. Various clarifications will be given in the cloud group. Solutions to various case studies will be given in the cloud group. So it is essential that you join the cloud group. Subhash from Rajendra PLC. Can you please repeat the whole slide? Which slide you are talking about, Subhash? Can you tell me which slide you are talking about? Okay. Slide number 1. Yeah. We'll tell you. We've just started. So objectives. In this session you will learn identify accounting standards, generally accepted accounting principles gap. Understand the significance, that is importance, of having accounting standards in an economic scenario. Understand the need for having global financial accounting standards. That is the background that I had given you. What are accounting standards? Let us see. Accounting standards are also known as generally accepted accounting principles, GAAP. So acceptability is a very important word. These accounting principles, accounting concepts, accounting standards, these must have acceptance all over the world. That is the important thing about accounting standards. So are known as generally accepted accounting principles are a set of rules and regulations or guidelines. So what are these accounting standards? They are certain rules, principles, regulations and guidelines. Next, are used in the preparation and presentation of financial statements, that is, bookkeeping, accounting and reporting. So bookkeeping, accounting and reporting, this is the basic thing. Whenever there is a business transaction, that business transaction has to be written in the books. From the books, various statements are prepared and these statements are given to the users of the financial statements. Next, are to be complied mandatory by firms and corporations. So these are to be compulsorily followed by the firms and corporations, mainly the firms and corporations which have issued shares to the public. Are issued mostly by accounting bodies for the respective countries. These accounting standards are issued by whom? By the accounting bodies for the respective countries. For example, in the US, the Financial Accounting Standards Board, FASB, issues the US GAAP. So the US GAAP is issued by FASB. What is the significance of accounting standards? That is, what is the importance of accounting standards? The significance of accounting standards are: number 1, uniformity, harmonization, standardization, high quality financial statements and provision of guidelines on complicated issues. So these are some of the important items which are there for the accounting standards. Significance, importance of accounting standards. It is based on these 5 important points. Uniformity. Uniformity means the accounting method and the reporting method has to be uniform and uniformly followed by the entities in an economy. So all entities must have a uniform accounting standard. Uniformity should be there regarding the accounting as well as the reporting. Two aspects are there. Second, harmonization. Harmony, all of you know, harmony has to do with music. Harmony means there should be an agreement. Here also, harmonization has the same meaning. Here also harmonization has the same meaning. Harmonization means it is a combination, combining various accounting policies, procedures and practices into a single set of accounting standards. So various countries will be having their own accounting procedures, policies and practices. These have to be combined into a single set of accounting standards which are acceptable worldwide. That is the meaning of harmonization. So combining various accounting policies, procedures and practices into a single set of accounting standards. Next, standardization. Standardization means there should be a standard method by which the financial statements are prepared. The financial accounting aspect as well as the reporting aspect, there should be a standardization. If there is standardization, then it will be accepted all over the world. Next point, high quality financial statements. Financial statements which are prepared according to accounting standards will result in high quality financial statements which will be acceptable, reliable, and it will also give a true and fair view of the affairs of the company. Next point, provision of guidelines on complicated issues. These accounting standards are issued after a lot of research and by taking the best practices all over the world. So two important things. First, lot of research is done. Second, the best practices followed all over the world, those are adopted. And because of these two conditions, these accounting standards will give you guidelines as well as guidance regarding new and complicated issues. So these are some of the significance of accounting standards: uniformity, harmonization, standardization, high quality financial statements, and provision of guidelines on complicated issues. These are possible because of the accounting standards. The following figure represents the need for global accounting standards. So why global accounting standards? What is the necessity? First, globalization, as I already told you. Because of globalization, because companies are now becoming multinational companies, they are having business interests in different parts of the world. Second, uniformity and harmonization in financial reporting. Third, consolidation of foreign subsidiaries. Fourth, raising funds in the international capital markets. Fifth, high quality reporting standards. Next, cross-border merger and takeover. And finally, uniformity in the application of other norms and regulations, for example, the Basel Committee. So these are the various points which are to be taken into account, which give an idea about what is the necessity for having global accounting standards. The first point, globalization. This one already I have discussed, already I have told you that because of globalization, the financial statements of a company must be acceptable, and the financial statements of a company will be acceptable only when certain universal global accounting standards are followed. Only then it will be acceptable all over the world. And if it is acceptable all over the world, then these multinational companies will be able to get themselves listed in the various stock exchanges all over the world, as well as they will be able to raise funds from the various capital markets all over the world. So this is the advantage. Then what is happening today in the age of globalization? What is happening is various merger and acquisitions are taking place. One company is merging with another company. One company is taking over another company. This is happening all over the world. Various Indian companies are there which are taking over other foreign companies. Similarly, many foreign companies are there which have taken over Indian companies. So merger, acquisition, takeover, all these are happening on a regular basis. As a result, this uniformity, harmonization of financial reporting is very, very essential. Next, third point is consolidation of foreign subsidiaries. This foreign subsidiaries which are there, that means a company may be having a foreign subsidiary. Now, if it has to provide one statement, financial papers, financial reporting if it has to do, now what are the procedures to be followed? So that is the reason these global accounting standards, they give you various guidelines regarding the consolidation of foreign subsidiaries or the reporting about the foreign subsidiaries, reporting about the operations of the foreign subsidiaries. Then raising funds in the international capital markets, already I have told you, high quality reporting standards which are acceptable all over the world. Cross-border means between two countries, merger, acquisition, takeover, and uniformity of application of other norms and regulations. For example, Basel Committee. Basel Committee is the committee on banking supervisory norms. Various banking rules are there, various banking regulations are there which are now to be implemented by banks all over the world. All banks all over the world have to follow these guidelines given by the Basel Committee. So these are some of the indications of the need for global accounting standards. The following figure represents the various entities that support global accounting standards: G20, World Bank, International Monetary Fund, Basel Committee, and other global financial institutions. All these support the global accounting standards. G20, this is a forum of 20 top economies in the world. World Bank is a financial institution which aims at financial stability all over the world. Similarly, International Monetary Fund, this is an international organization, financial organization, and almost 200 countries are members of this International Monetary Fund, and the main aim of International Monetary Fund is to have financial stability all over the world and to foster global economic cooperation. Basel Committee, as I told you, Basel Committee is regarding the banking supervisory norms. Various norms and regulations which are to be implemented by the banks are given by the Basel Committee. And various other global financial institutions are there. So all these, they are supporting the global accounting standards. And global accounting standards, therefore, they have become very essential for all countries and for all business entities who want to do business globally. What is global harmonization with IFRS? Global harmonization. As I told you, what is harmonization? I told you, harmonization means combining various accounting policies, procedures, and practices into a single set of accounting standards. This is what we call IFRS, International Financial Reporting Standards. There was always a need to bring harmonization in accounting practices. Harmonization means agreement. So there should be agreement between the various accounting policies. That means there should be uniformity in the accounting policies followed by countries all over the world. That is, to minimize the area of difference between accounting standards and practices issued by accounting bodies in different countries. So there should be some uniformity. And once there is uniformity, that acceptance will be there. Global acceptance of the accounting policies and procedures. Next point. Since the last decade, efforts have been geared towards convergence and adoption of International Financial Reporting Standards, IFRS, International Financial Reporting Standards. So these are the standards which have to be followed by all the countries. The goal of convergence project is to issue a single set of high quality international accounting standards, IAS and IFRS, that the companies can use both for domestic as well as cross-border financial reporting. So convergence, what is this convergence? Convergence means one country will issue a set of accounting standards. These set of accounting standards will be compatible or will be in agreement with the global accounting standards. What are the global accounting standards? International Accounting Standard, IAS, as well as IFRS, International Financial Reporting Standards. So this is called convergence. The country will be issuing a set of accounting standards which will be compatible with the international accounting standards, but at the same time certain local considerations also will be taken into account. So that is the meaning of convergence. Convergence actually means meeting at a point. So what is happening is that the global accounting standards are now almost made similar with the local standards. So whatever accounting standards are issued by a country, those accounting standards are very compatible with the accounting standards globally, and certain local issues are also taken into account. So that is what we call converge. One accounting standard, another accounting standard, two accounting standards are converging. Mayank from DCP says, you are running quite fast, so please go slow. See, this course, please understand one thing, this course is very vast and I have to cover the entire course within a period of time. Time is limited also. So if you understand that, it will be very good. And that is the reason why I told you, before coming to class, please go through the ebook. The ebook that has been given, go through the ebook. That will help you to understand and appreciate what is being taught in class. History of accounting standards, history of global accounting standards, IFRS and US GAAP. 1973, International Accounting Standards Committee, IASC, was formulated that issued the IAS till 2001. So there was this committee, IASC. What is IASC? International Accounting Standard Committee. This International Accounting Standard Committee issued all the accounting standards which are called IAS or International Accounting Standards till 2001. 2001, IAS was reformulated into IASB, hence worked more proactively to issue IFRS that has been widely accepted. Since 2001, IASC has now been converted into IASB. IASB stands for International Accounting Standards Board. This International Accounting Standard Board is issuing the accounting standards which are called IFRS, International Financial Reporting Standards, which are widely acceptable. Harmonization and convergence of US GAAP and IFRS are still under progress since 2002. So there are talks going on so that US GAAP, that is the accounting standard of United States, and IFRS, these are the international accounting standards, can be converged or merged into one single set of accounting standards. Those talks are still going on. US GAAP has been logically structured in 2009 into the accounting standard codification structure. So US GAAP is now called the Accounting Standard Codification, ASC. Codification means in code language the various items of the accounting will be listed, which we shall study in a subsequent session. Subhash from Rajendra PLC, can you explain convergence with a suitable example? Okay. Convergence. What is convergence? Convergence means issuing a single set of accounting standards which is compatible with the international accounting standards and also taking into consideration the local accounting standards. So local issues are also taken. So this is what is happening in convergence. Say for example, India, our country, they have issued a set of accounting standards which are compatible, which are in agreement with the international accounting standards, IFRS, and at the same time certain local issues have also been taken into account. And what we get finally is IND AS, IND, capital A, capital S, Indian Accounting Standards. So that is convergence. Convergence, as I told you, means meeting. So what is happening? The Indian authorities, they have issued a set of guidelines, accounting standards, which are in agreement with the international accounting standards, but at the same time certain local issues have also been accommodated. So that is what we mean by convergence. The following figure represents the two widely accepted accounting standards, IFRS, accepted and applicable in more than 120 countries, for example, the European Union and G20 countries, and US GAAP, applicable to public and private limited entities registered and reporting in the US. So IFRS accepted in more than 120 countries, US GAAP is applicable and for those entities which are registered and reporting in the US, United States. So these are the two major global accounting standards, global financial accounting standards, IFRS, International Financial Reporting Standards, and US GAAP, United States Generally Accepted Accounting Principles. Devale from GTANK, is the term convergence of accounting standards similar to combination of accounting standards? It is not exactly combination, because the accounting standards which are issued by a country, those will be in agreement with the international accounting standards, but certain local aspects are added to that. So slight. Just like if you are cooking a dish, for eating. So at the end, what do? Thoda sa masala. You give little masala. So just like that, the local issues are taken into account. That's all. That is the meaning of convergence. Quiz. What is the linkage between accounting standards and accounting concepts and conventions? Are they independent or interdependent? What is the linkage? That is the link between accounting standards and accounting concepts and conventions. Are they independent or interdependent? Now, what are accounting concepts and what are accounting conventions? We must understand that. Accounting concept means certain accounting principles or rules that we follow. And accounting convention means the way something is done, the way accounting is done. Now, there is a link between the accounting standard and accounting concepts and conventions, because all accounting standards are based on these accounting concepts and conventions. So without accounting concepts and conventions, accounting standards would not have been possible. So they are interdependent. So please remember that whatever accounting concepts or conventions were there or are there, on the basis of this, the accounting standards have been formulated or issued. Second question, are accounting standards mandatory or optional for different organizations? It depends upon the type of organization. Public limited companies, for them it is mandatory, and the respective accounting bodies in different countries, they have issued various guidelines as to for whom it is mandatory and for whom it is optional. So various countries all over the world, they have given the guidelines. Kiran from South Extension, accounting convention. Convention means the way something is done, the way accounting is done. That is the meaning of convention. The way accounting is done. Accounting is done in a particular way. When a business transaction takes place, the voucher or the various papers, related papers are verified, then they are certified, and then they are accounted for in the books. The ledger, the general ledger, the subsidiary ledger, various books are there. This is called the bookkeeping. From the bookkeeping, we go on to the balance sheet, the trial balance and the balance sheet. So in this way, the convention is followed. These are called the accounting conventions. So what have we learnt in this session? In this session you have learnt GAAP accounting standards are principles and regulations that provide a framework, that means a structure, framework means a structure, in preparation and presentation of financial statements. So this is the base. Based on these principles and regulations, the accounting financial statements are prepared. And financial statements, as I told you, they comprise of the balance sheet, the profit and loss account or the profit and loss statement, and the cash flow statements. The need for a single set of global accounting standards arose, that means from globalization, requires a single set of high quality accounting standards. And IASC, India International Accounting Standards Committee, was formulated in 1973 for issuing the IAS, International Accounting Standards, and it has accelerated since 2001, and it is getting widely accepted in more than 120 countries. Niharika from Connaught Place, please repeat the second answer. Second answer, okay. Second answer is, are accounting standards mandatory? Mandatory means compulsory, or optional. That means there is an option. They can do, they cannot, they can follow, they may not follow for different organizations. So this depends upon the nature of organization. This depends upon the nature of organization. Those organizations which have issued shares to the public, for such organizations, for public limited companies, it is compulsory to follow. And different countries have given different guidelines regarding for whom it is compulsory and for whom it is optional. So this depends upon the country. as we shall see in the subsequent sessions. Okay, so we'll go to the next session. The next session is regarding the IFRS, International Financial Reporting Standards. This is the next session. Now, let me tell you one important thing. All of you must attend the class on time. The class timing is 9 a.m. to 11 a.m. every Monday and Wednesday. And I will expect that all of you are there at 9 o'clock. The class will start at 9 o'clock. A grace period of 5 minutes is allowed only. Within 9:05, I shall be starting the class every day. So please be there right from the beginning. If you are not there right from the beginning, you are going to miss out very important points, and ultimately what is going on in the middle of the session, you will not be able to catch up. So it is very essential that all of you come for attending the session right on time, that is at 9 o'clock. Don't delay. If you delay, ultimately you will be missing out various important things. So please do not delay. Second session. In this session you will learn, understand the scope and meaning of International Financial Reporting Standards, IFRS, International Financial Reporting Standards. Identify the applicability of IFRS, understand the significance, that is importance and advantages of IFRS, understand the conceptual framework and structure of IFRS. That means based on what idea this IFRS has been structured. That is the meaning of conceptual framework. Understand the issuance process of IFRS. Understand the adoption and convergence to IFRS. Adoption means implementation. Convergence, as I told you, means issuing a set of accounting standards which are compatible with IFRS, but at the same time certain local issues are also taken into consideration. And identify accounting standards and IND AS, Indian Accounting Standards. In short it is called IND AS, applicable in India. The following figure represents the features of IFRS, popularly known as IFRS. In short, it is known as IFRS, International Financial Reporting Standards. Single set of high quality, understandable and enforceable, globally accepted accounting standards. So, it is a single set of high quality. That means if it is high quality means the financial statements will be reliable and the financial statements will give a true and fair view of the affairs of the company. Understandable, easy to understand, enforceable, can be forced as per the law of the land. That means you have to follow. Enforceable means the entities have to follow. And globally accepted accounting standards. Accounting standards which are accepted all over the world. Globally accepted accounting standards. Scope of IFRS. What is the scope? IFRS sets out in respect of transactions and events in general purpose financial statements in the areas of number 1, recognition, number 2, measurement, number 3, presentation, number 4, disclosure requirements. IFRS applies to financial reporting by profit-oriented entities. The jurisdiction of IFRS spreads across 130 countries. For example, G20 countries and 110 other countries. So this is the scope of IFRS. So first point is IFRS sets out in respect of transactions and events in general purpose financial statements. Financial statement, as I told you, financial statement means balance sheet, profit and loss, cash flow statement. These are the main financial statements. Now, these financial statements are prepared as per the generally accepted accounting principles. They are not prepared as per the requirement of an individual or an entity. That is the reason why such financial statements are called general purpose financial statement. That is, it is acceptable by other users, various users of the financial statements. Who are the users of the financial statements? First, it may be the banker who is given a loan to the organization. He wants to know about the financial health of the organization. So he will ask for the balance sheet, he will ask for the profit and loss statement, he will ask for the cash flow statement. Similarly, the income tax department may want to know, the government may want to know, the suppliers and vendors, they may want to know, and the shareholders, they also may want to know how is the company performing, how is the company's performance, what are its future plans. So that these are all the users of the financial statements. And because these users, the financial statements have not been made as per the requirement of the user, that's why it is called general purpose financial statement. So four important points are there: recognition, measurement, presentation and disclosure requirements. Recognition means identification. How to identify that item. For example, inventory, raw material. These are how to recognize that. So first is recognition. How will you recognize the item? In the balance sheet, various items are there. Various items of assets are there. Various items of liabilities are there. Now how to recognize each item? So IFRS gives you guideline on that. Second, once it is recognized, how to measure? Third, how to present in the balance sheet. Each item of assets and liabilities, as per the books, they are consolidated and aggregated into the balance sheet of the company. So how to present these items in the balance sheet? In what format the balance sheet has to be made? Next is the disclosure requirement. Certain items which may not find a place in the balance sheet, disclosure has to be made as a footnote in the balance sheet. In the balance sheet, as a footnote, certain disclosure has to be made. Say for example, suppose a case has been filed against a company, or a company has given a guarantee for some other firm or company. So such items are to be reported in the disclosure to the balance sheet. So these assets and liabilities which are there in the balance sheet, certain disclosures which are required for these assets and liabilities also take into account the risk factor. What is the risk involved in any of these assets or liabilities? This disclosure also has to be mentioned. So these are some of the important areas which are taken into consideration while preparing the financial statements. Shivangi from South Extension, can you please go slow? Okay. Just one from Saitanagar. What is G20 countries? G20, this is a group or a forum of 20 top economies. This is a forum of 20 top economies, including India. Subhash from Rajendra PLC, G20. uh, in G20 what ISG stands for. Where is ISG? I am not able to understand. Where is ISG? No, I don't know where you are talking about ISG. Let me see. This is G20. Where is ISG? Where did you find the word ISG? I am not able to understand. G20. This is G20. You can see here. G20 is a group of 20 top economies of the world. G20 is a group of 20 top economies of the world. Okay. So IFRS applies to financial reporting by profit-oriented entities. So those profit-oriented entities, they have to follow this IFRS. Jurisdiction of IFRS spreads to 130 countries. Jurisdiction means the area of coverage. Jurisdiction means the area of coverage spreads to over 130 countries. Disha from Hazra says, can you explain Basel Committee? Basel Committee is the committee which has been formed for banking supervisory norms. Various banking accounting procedures, accounting norms, all these are taken care of by the Basel Committee. For example, suppose there is a non-performing asset. Those loans which have become bad, what is the accounting procedure for such loans? All these are given by the Basel Committee. All these are given by the Basel Committee. All these will be given by the Basel Committee. Subhash from Rajendra PLC, G20, what does G stand for? Group of 20 countries. Group of 20 countries. G. The following figure represents the advantages of IFRS. What are the advantages? As you can see, globally comparative financial statements. Second, global takeover and merger. Third, cross-border listing. Next, consolidation with foreign subsidiaries. Next, access international capital markets. Already we have discussed regarding all these. These are the advantages. Globally comparative financial statements. That means the financial statements which an entity prepares based on the international financial reporting standards, these are accepted globally. All over the world, acceptance is there. And because this acceptance is there, they are able to raise funds from various capital markets all over the world. They can also get themselves listed in the various stock exchanges all over the world. This is the advantage. Next, global takeover and merger. One Indian company is taking over, let us say, a Japanese company. Now, how to take over? How the accounting is going to be done? Unless both of them follow certain international accounting standards, it will be difficult to have some accounting standards for consolidation. So global takeover and merger is to ensure that the accounting standards are followed uniformly. It is essential that both the countries, both the entities follow uniform practices, uniform policies, uniform accounting standards. Cross-border listing, already I have told you. Listing means your listing of the company in the stock exchange of the country. Once the listing is done, thereafter the shares of the company can be traded in the stock exchange. For example, suppose an Indian company wants to issue the shares in the USA, then that company must be first listed in the stock exchange. Once the listing is done, thereafter the shares can be traded in the American stock exchange. So for all these, unless you have certain financial statements which are acceptable, you will find it difficult to get your organization listed in the different countries. Next, consolidation with foreign subsidiaries. Consolidation means the parent company is merging with the foreign subsidiary. Both companies are merging together, or they are presenting a consolidated statement. One company may have a foreign subsidiary. Say for example, one Indian company is having a foreign subsidiary in USA. Now, the Indian company's balance sheet is in Indian rupees. Whereas in the USA, the foreign subsidiary is doing entire transactions in the US dollars. Now on the balance sheet date, let us say 31st of March, the balance sheet has to be brought out by the Indian company. Now how will the accounting be done for the foreign operations of the company? So this accounting standards will give you the guidelines or the guidance of how this presentation of the balance sheet is to be done for such companies who are having foreign subsidiaries. This is what we call the consolidation, consolidated financial statement. And the last point is access international capital markets. This point already I discussed, that unless you have financial statements which are acceptable worldwide, you will not be able to get access to the various international capital markets for raising the funds. Guest one from Satyanagar, so provide me your mail ID or contact number. See, if you want to interact with me, the cloud group is there. That is the reason why you have to be a member of the cloud group. You have to join the cloud. The cloud group which is there, you have to join the cloud group. That is how you have to interact with me. Any question, any clarification, you can interact with me in the cloud group. I am always there. I am ready to answer all your queries and doubts. Rituparna from Pan Bazar, Guwahati Pan Bazar. Please repeat point number 3. Okay. Vandana from Durgapur, give me your contact number and email ID. As I told you, if I start giving my contact number and ID, email ID, what is going to happen is that I will be getting hundreds of mails which may not be possible for me to individually reply. But in the cloud group, what is going to happen is that I will see the common questions which are there. Based on that, I will give a one answer. So please join the cloud group. That will help you to clarify various doubts which you are having. Okay, point number 3 is cross-border listing. Cross-border means what? The international, every country has got one international border. This side of the country is India, this side of the border is India, this side of the border is Pakistan. That is what we call cross-border. So the listing of one company in another country, that is called cross-border listing. Where is the listing taking place? Listing will be taking place in the stock exchange of another country. So when one company wants to list itself in the stock exchange in another company so that the shares of that company can be traded, that is called the cross-border listing. Ivangi from South Extension, please explain point number 4. Point number 4 is consolidation. Suppose, for example, I give you the example of an Indian company. The Indian company is doing business in India. It is preparing its balance sheet in Indian rupees. Balance sheet means balance sheet, profit and loss statement, cash flow statement, all these are prepared in Indian rupees. Now, if the Indian company is having a foreign subsidiary, that means it has got another branch at USA. The Indian company is having a branch at USA. So that is called the subsidiary, foreign subsidiary. Why it is called foreign subsidiary? Because the branch of that company is located in a foreign country. That's why it is called foreign subsidiary. Now, the foreign branch will be doing the transactions in US dollar. All the balance sheet and everything of that foreign subsidiary will be in US dollars. But the parent company, the company which is owning that branch, that company is located in India. Its balance sheet is in Indian rupees. Now, how to consolidate a balance sheet? So these guidelines are given by the accounting standards. The following figure represents the drawbacks of IFRS. What are the drawbacks? Drawback means what are the negative aspects of IFRS? Number 1, there is cost of adopting and implementing IFRS. That means any company which wants to implement IFRS for the first time, there is a cost involved. Second point, there are lower levels of details in IFRS as compared to US GAAP. The US GAAP is more detailed. It goes deep into various aspects, unlike IFRS. So IFRS is not as detailed as US GAAP. Third point, IFRS requires application of judgment. In certain cases, IFRS is subjective. That means two people may have different opinion regarding how something has to be done. So it requires application of judgment and discretion. Discretion means you are having the power to decide. Unlike US GAAP, which is rule-based. US GAAP is rule-based. This is the rule, you have to follow the rule. That's all. Whereas IFRS, it sometimes requires application of judgment and discretion. That means you have to decide yourself what will be the best thing to do or how you will do that. In certain cases, not all cases. So these are the drawbacks or the negative points regarding IFRS. There is a cost involved. IFRS is not as detailed as US GAAP, and in certain cases IFRS requires a judgment and discretion. Who issues IFRS? Who is the issuing authority for IFRS? Let us see. IASB develops and issues IFRS. What is the full form of IASB? International Accounting Standards Board. So IASB will be developing and issuing the IFRS. These are the accounting standards, International Financial Reporting Standards. IASB is an independent group with 15 full-time members coming from 9 countries, having a variety of background with a mix. The IASB has its headquarters in London. So the International Financial Reporting Standards, IFRS, is developed and issued by IASB, International Accounting Standards Board, which is an independent group having 15 full-time members coming from 9 countries and having variety of backgrounds with a mix. And the headquarters is at London. Subhash from Rajendra PLC. If one subsidiary is located in USA, is it compulsory to follow US GAAP? It is compulsory to follow US GAAP, but suppose you follow the IFRS, then you have to inform the respective authorities you are following the IFRS, but if they accept it, then it is okay. Otherwise, if it is listed, the rule is you have to follow the US GAAP. IFRS hierarchy statement consists of, hierarchy means the level, different levels. IAS, IFRS, SIC, IFRIC. IAS, International Accounting Standards. IFRS, International Financial Reporting Standards. SIC, Standards Interpretations Committee. IFRIC, International Financial Reporting Interpretation Committee. So these are the various committees and standards which are there. IAS is the International Accounting Standards. First IAS was there. Subsequently, we have the IFRS. Today, we are having the IFRS as well as the IAS. Both are there. But whatever subsequent accounting standards are issued, all are under IFRS. Now, this SIC, Standard Interpretation Committee, interpretation means explain the meaning of, interpretation, explain the meaning of. So this committee will be giving you guidelines and guidance regarding various aspects of IAS. Whereas IFRIC, this is also an interpretation committee. Interpretation, as I told you, interpretation means explain the meaning of, that is the meaning of interpretation. So this IFRIC will be giving you guidance and clarification regarding various aspects of IFRS. So please remember this thing. SIC gives you guidance regarding IAS. IFRIC gives you guidance regarding IFRS. So IAS and SIC, they are connected. IFRS and IFRIC are connected. So first and third, second and fourth. First and third, second and fourth. So in this way, the hierarchy is there. IAS, International Accounting Standards. Any clarification, interpretation is given by SIC, Standard Interpretation Committee. And for International Financial Reporting Standards, IFRIC, that is International Financial Reporting Interpretation Committee, this gives you guidance regarding any IFRS matter. Okay. Now you can see the following figure. From 1973 to 2001, we had IASC, International Accounting Standards Committee, which issued the IAS and SIC. Since 2001, we have got the International Accounting Standard Board, IASB, which is issuing IFRS and IFRIC. So 1973 to 2001, we had the International Accounting Standards Committee, which issued the IAS and SIC. Since April 2001, the IASB, International Accounting Standard Board, is issuing the IFRS and IFRIC. So issuance body, as you can see, this is the breakup which has been given. Till 2001, IASC, it has issued 41 International Accounting Standards and 33 SICs. From 2001, the IASB has issued 15 IFRS and 33 IFRS. So this is the position, this is the breakup which has been given till 2001 and 2001 onwards. So just remember one thing, till 2001 IASC, that is the International Accounting Standards Committee, was issuing the IAS and SIC. From 2001 onwards, the International Accounting Standard Board, it is issuing the IFRS and IFRS. So at this stage we'll take a short break of 2 minutes and we'll come back. We'll take a short break. Okay, welcome back. So let me tell you two important things. First is that all students are expected to be there on time every day. Because if you join the session late, you will be missing out a number of things, and ultimately what is going to happen is that you will not be understanding what is going on in the session. So don't miss the beginning. Very important that you should be there right from the beginning, and you should be there throughout the session. That is very essential. And as I give you the details about the cloud group, the cloud group name is REV GNIIT GFAS 160883. Please join the cloud group. The cloud group is essential for you to interact with the faculty, as well as to interact with other students, as well as to get your any clarification and doubts. You can clarify your doubts through the cloud group. So that is very important. And second is that another important thing is that please read the ebook which is made available to you. Go through the ebook. Try and understand what are the various matter which is there in the ebook. And once you read your ebook and then come to class, what is going on in the class, you will appreciate that much better. Because this is a new subject, it is better that you go through the ebook and then come prepared in the class. So next we'll go on to the conceptual framework of financial reporting. Conceptual. Conceptual means based on some idea, concept, idea. So what is the framework? Framework means the structure. Number one is a set of theoretical principles. That means principles which are based on certain theory. Provides the basis for development of new standards. Helps in evaluation of those standards which are already in existence. Forms the framework of reference for financial reporting and harmonizes and brings uniformity in regulations governing accounting standards. So these are the basic important things about the IFRS. First point is set of theoretical principles based on certain theory, based on certain rules. These are formulated. Second point, provides the basis for development of new standards. If any new standards are to be developed, then this is the basis, this is the foundation through which you will be able to develop new standards. Third, helps in evaluation of those standards which are already in existence. You can evaluate, you can make an assessment whether the existing standards are still relevant or not. What is happening in this global world is that everything is changing. A standard which was there maybe 10 years back, is it still relevant? Can it still be used in today's world? So this type of assessment has to be done, this type of evaluation has to be done. Fourth point, forms the frame of reference for financial reporting. So this is the basis, this is the foundation for all type of financial reporting. And harmonizes and brings uniformity in regulations governing accounting standards. That means the various accounting standards, various accounting policies, various accounting procedures, various accounting practices which were followed all over the world by different countries, these have to be now harmonized, combined, and on the basis of that combination, a single set of accounting standards have been issued. And this is what we call IFRS, International Financial Reporting Standard. So this is the structure or the framework of IFRS. The following figure represents the overall consideration in preparation and presentation of financial statements. So financial statements which are prepared, they are prepared on the basis of certain concepts, accounting concepts. On the basis of these accounting concepts, the financial statements are prepared. So what are these concepts? Going concern, accrual basis, fair presentation, consistency, materiality, aggregation, offsetting, comparative information, and IFRS compliance. Okay, so the first point is going concern. Going concern means the financial statements of an entity will be prepared taking into consideration that this entity is not going to close down its business in the near future. So it is going to continue in business. On that basis, the accounting, the standards as well as the preparation of the statements are done. This is called the going concern basis. Going concern means the entity will go on doing its business in the near future. This is called going concern basis. Next is accrual basis. Accrual basis means any revenue or expenditures which has fallen due must be accounted for irrespective of whether cash has been received or cash has been paid. So this is called the accrual basis of accounting. In the accrual basis of accounting, say for example, suppose a sale has been made. Although the money will be received after 30 days or 45 days, but you can account for that revenue now. Why? Because you have already delivered the goods to the buyer. Buyer will pay after 45 days. So after 45 days you will receive the money, but you can account for the revenue today itself. Why? Because you have made the sale today. So that is what we call accrual basis. Similarly, any expenditure which has fallen due, that you have to account for. For example, suppose an entity has taken a loan. In that loan, the interest is payable quarterly. If that is the case, then every month the entity has to make a provision for the amount of expenses on interest which it has to pay. So every month it will be accounting for the interest, and on the third month, whatever accounting has been done for the interest, the full amount will be paid. So this is what we call accrual basis. Another example. Say the final reporting date of an organization is 31st of March. That means 31st of March is the date when the balance sheet will be prepared and the books will be closed and the financial statements will be prepared. On what date? 31st of March. Now the electric bill for the company for the month of March will be received only in the 15th of April. But the bill relates to the month of March. So in the month of March, as on 31st March, you have to debit your expenditure account to the extent of the electric bill for the month of March, and you have to account for that and keep the money separately as outstanding liabilities. So this is another example of accrual basis. So accrual basis of accounting says that revenue and expenses which have fallen due have to be accounted so that all revenue and expenses for an accounting period will be accounted for. Rituparna from New Paran Bazaar. Please repeat accrual basis. Already I have told you accrual basis. I have given you several examples. I hope you have understood. Next, fair presentation. Fair presentation means the financial statements which are prepared as per the accounting standards, global accounting standards, this will give you a true and fair picture of the financial state of the company. So that is called fair presentation. The financial statements which are prepared in accordance with the global accounting standards will give a true and fair view of the affairs of the company. What is fair? Fair means unbiased. Nothing will be, that means nothing will be stated which is wrong. It will give the correct picture, the fair picture of the affairs of the company. Next point is consistency. Consistency means uniformity. Once an entity has adopted an accounting principle, that accounting principle has to be followed consistently from one period to another period, one accounting period to the next. That means I cannot be changing my policy every now and then. If I have adopted a certain accounting policy, I have to follow that policy. If I have adopted a rule, various types of rules may be there. Say for example, valuation of inventory. At the end of the financial year, every entity has to value the inventory. Inventory means raw material, stock in process, finished goods, all these have to be valued. Now there are various methods of valuation. Now if an entity has adopted one method, then that method has to be followed consistently from one accounting period to the next. Only then comparability will be possible. You can compare the balance sheets of different years. Otherwise, comparability will not be possible. For example, suppose one entity has adopted method 1 for valuation of inventory this year. Next year, instead of following method 1, it follows method 2 for valuation of inventory. Next year it follows some other method. So if this happens, then I cannot compare the results of the financial statements cannot be compared from one period to another. I cannot compare. Comparison will be useless because the entity is following different accounting methods from one period to another. So that is the meaning of consistency. The accounting policy which has been adopted by the company has to be consistently followed from one accounting period to the next. Next, materiality and aggregation. Materiality means any information or any item which will affect the influence, which will influence the user of the financial statement, that item is called material item. Hence, when a company is preparing its balance sheet, all items, all material items have to be shown in the balance sheet. If one item is not material, that may be combined with another item. But if it is material, it will, if it affects the influence, if it influences the decision of the user, then it has to be shown separately. So that is what we call material aspect, materiality. So materiality aspect of accounting says that any item which will affect the decision of the user or which will influence the decision of the user, all these items are said to be material, and all these items have to be shown separately in the balance sheet. It cannot be combined with other items. And aggregation. Aggregation means consolidation. What we are doing is we are having various books. The subsidiary ledger is there, the general ledger is there, other ledgers are there, the journals are there. From all these ledgers, whatever accounts are there, various accounts are there. It may be accounts payable, then it may be account receivable, it may be cash, it may be bank account, various accounts which are there. These have to be aggregated, totaled up and shown in the balance sheet. This is called aggregation. Say for example, account receivable. What is account receivable? Whenever any sales are made, we are debiting account receivable and we are crediting our sales account. So we are accounting for the revenue. Now if a company has got say 50 buyers, so there will be 50 account receivables, separate items will be there, account receivable. Now all this account receivable has to be consolidated and shown as a single figure in the balance sheet. So this process is called aggregation. Aggregation means combining and showing a single amount. Next item is offsetting. Offsetting means combining two items. Maybe one debit item is combined with a credit item and the net amount is shown. Offsetting is not permitted unless allowed by the accounting standard. So offsetting cannot be done. Amount of asset combined with liability, amount of income combined with expenses, this is not allowed unless it is permitted by the accounting standard. Next, comparative information. Comparative information means whenever the balance sheet is taken out by the company, the comparative figure of the previous year has to be shown. Say for example, the balance sheet of 31st March 2017 which has been bought out by the company will also contain the comparative figure of 31st March 2016. So every balance sheet has to have the comparative figure of the previous financial year. And last is IFRS compliance. This is very important. All entities have to certify that the accounting standards of IFRS have been followed. So these are some very important aspects which are taken into consideration as far as IFRS is concerned. The following figure represents the methodologies of global harmonization with IFRS. Global harmonization. What is harmonization? Already I told you in the beginning. Harmonization means combining various accounting procedures, policies and practices into a single set of accounting standards. What is happening is various countries all over the world, they are having their own accounting standard, own accounting policy, own accounting procedures. Now if that is the case, then acceptance will be difficult. So what is required is, we should have harmonization. That means a single set of accounting standards will be issued, whereby these accounting standards will be acceptable all over the world. Now there are two methods for this. First is called adoption, second is called convergence. So global harmonization with IFRS, two methods are there to accept the IFRS and implement the IFRS. One is called adoption method. In the adoption method, the entities or the country will be implementing IFRS. So what will the country do? It will implement IFRS and it will accept IFRS as the accounting standard. So that is called the adoption methodology. Convergence methodology. In the case of convergence methodology, as already I explained earlier, the country will be issuing a set of accounting standards which is compatible with IFRS. Compatible means which is in agreement with IFRS, but at the same time certain local considerations are also accommodated. So certain local issues are also taken into consideration. This is what we call convergence. So adoption means implementation of IFRS. Convergence means issuing a set of accounting standards compatible with IFRS, but at the same time taking certain local issues into consideration. So two methods are there for adoption. Ridhima from DCP, last point is IFRS compliance. Last point is IFRS compliance. IFRS compliance means you have to give a certification in the balance sheet that you are complying with the global accounting standards. That certification has to be given by the entity which has brought out the balance sheet. The following figure represents the various key challenges in IFRS convergence. So what are the challenges faced? Number 1, amendment in the regulations. Number 2, IT system changes. Number 3, determination of the impact. Number 4, conversion of historical data. Number 5, availability of professionals. And last is fair value measurements. So, convergence, as I told you, means the country will be issuing a set of accounting standards which are compatible with IFRS, and at the same time local issues will also be accommodated. So during this, when this is done, certain aspects have to be taken into consideration. Amendment in the regulation. Regulations have to be changed. The government has to change the regulations. It has to change the IT system, the system through which the accounting is done. That has to be changed. Then, conversion of historical data. That means the data based on which the previous statements were made, that has to be changed. Determination of the impact. What will be the impact? What will be the effect on the various entities? Availability of professionals. Professionals who are well trained, who have got great knowledge about the various accounting aspects of IFRS. So because the country is issuing a set of guidelines which is as per the international requirements, the professionals who are there, the various chartered accountants, etc., they have to update their knowledge. And fair value measurements. Fair value measurement means the international accounting standard says the items of assets and liabilities have to be measured at the fair value. That means the value. So these are all which are connected with the IFRS convergence. The IT system changes, determination of impact, convergence of historical data, conversion of historical data, availability of professionals, and fair value measurements. There is a case study which is IFRS and applicable balance sheet. That is, which are the points, which are the items covered in IFRS and IAS. This I am not showing you. But what are the impacts? That is what we are going to study. So as you can see, IFRS, IAS impacting the financial statements. What are the various impacts? IAS 1, IAS 8, IFRS 8, IAS 34, IAS 27, IFRS 10, IAS 18, IAS 21. These are some of the important accounting standards. IAS 1 deals with the preparation of financial statements, presentation of financial statements. Presentation means how the financial statements are going to be presented in the balance sheet. How the various items of assets and liabilities will be shown in the balance sheet. That is called the presentation. Presentation means various items of assets and liabilities, how they will be shown in the balance sheet. That is called the presentation. So IAS 1 deals with the presentation of financial statements. IAS 8 deals with accounting policies, changes in accounting estimates and errors. Suppose there are changes in the accounting policy, accounting estimates, or suppose there are errors which have been detected now, how to account for such things. These are dealt with in IAS 8. Next, IFRS 8 deals with the operating segment. Operating segment is that part of the business which is giving you the profit. So the operating segment is dealt with in IFRS 8. IAS 34 deals with interim financial statements. Interim means in between. The financial year is from 1st of April to 31st of March for India. Now in between, the companies are required to come up with quarterly statements. These are unaudited and abridged quarterly statements. June, September, December. So these are called the interim financial statements. Next, IAS 27 and IFRS 10 deals with separate and consolidated financial statements. Once a company, if it has a number of subsidiaries, how to consolidate and present the statement. IAS 18 deals with revenue recognition, when to recognize the revenue, and IAS 20 deals with foreign currency accounting. So all these we are going to cover in the subsequent sessions, but just briefly I have given you the details. Andale from Borivali, at what time the session has started? 9 o'clock, 9 a.m. This session is from 9 a.m. to 11 a.m. Now we are coming to GAAP, Indian GAAP, Indian Generally Accepted Accounting Principles. Accounting standards in India, they are pronouncements issued by the government or a regulatory body. So the accounting standards in India, they are pronouncement. Pronouncement means they are statements. Statements which are issued by the government or the regulatory body. The accounting standards in India mean the standards of accounting issued by the Institute of Chartered Accountants of India, ICAI, and the Accounting Standards Board, ASB, since 21st of April 1977, and central government in consultation with the National Advisory Committee on Accounting Standards, NACAS. So the accounting standards in India, what are these? These are the accounting standards issued by whom? By ICAI, Institute of Chartered Accountants of India, ICAI. So ICAI is issuing these accounting standards, and the Standards Board of India, the Accounting Standards Board, since April 1977, and central government in consultation with NACAS, National Advisory Committee on Accounting Standards. So these are all the institutions which are connected with the issue of accounting standards in India. The Institute of Chartered Accountants of India, the Accounting Standards Board, central government, and the National Advisory Committee on Accounting Standards. Till date, 32 accounting standards have been issued. 3 levels of entities are there, have been defined for the applicability of the accounting standards. That means all entities are categorized into 3 categories, and these accounting standards will be applicable to different categories as per the rules. Andrea from Borivali, the timing has changed. The last session I attended time was 11 a.m. to 1 p.m. Which batch you are talking about? Andrea, can you tell me which batch you are talking about? This batch, this is a new GFAS batch S160883. This is a new GFAS batch. What are Ind AS? What are Ind AS? Let us see. Ind AS is a new draft of the Indian accounting standards that have been issued in convergence with IFRS. IFRS principles have been adopted in fitment. That means, fitment means as per the Indian scenario, fitting into the Indian scenario. That's why it is called fitment. So Ind AS, what is Ind AS? It is a new draft of the Indian accounting standards. So this is something very new which has been started. Ind AS, Indian accounting standards, that have been issued. So these are issued in convergence with IFRS. So this is a method of convergence with IFRS. That means the Indian government has issued a set of accounting standards which is compatible with IFRS, and at the same time certain local issues have also been accommodated. Next point, revised roadmap requires Ind AS to be implemented in the first phase of the companies having a net worth of more than 500 crores from the accounting year beginning on or after 1st April 2016. That means all entities who have got a net worth of 500 crores and above have to implement this from 1st of April 2016 with the previous year's comparative figures in the IAS for the year 2015-16. So from 1st April 2016, all companies having a net worth of more than 500 crores have to mandatorily implement this Ind AS. The Ministry of Corporate Affairs has notified 35 Ind AS till date. So how many accounting standards have been notified by the ministry? 35. Ministry of Corporate Affairs, MCA. So if you go to the MCA website, various matters you will be able to find out about Ind AS. Okay. Which one of the following options serves the purpose of IFRS? First, A, to protect the interest of investors. B, to simplify auditing procedures. C, to cut down management time and responsibility. So please raise your hand and give me the answer to the question. First question, please raise your hand and tell me what is the answer to the first question. Which one of the following options serves the purpose of IFRS? A, to protect the interest of investor. B, to simplify auditing procedure. C, to cut down management time and responsibility. Okay, Shivam from South Extension, Ritu Parna from Pan Bazar. Both of you have given the correct answer. Correct answer is A. Correct answer is A. Correct answer is A. Please remember, to protect the interest of the investor. That is the main purpose for issuing IFRS. So the investor who is buying the shares of the company will get a set of financial papers which are compatible with the IFRS. Second question. One of the objectives of IASB is to promote the presentation of financial statements using euro. Naturally, this is false. This is false. Second answer is false. Most of you have given the correct answer. Shivam, Shivani, Rituparna, Disha, Divakar, all of you have given the correct answer. Guest one from Saitanagar. Very good. So, second answer is false. Third, the cost or value of items in financial statements is never estimated. Estimate means the rough value, finding out the rough value. So, true or false? The cost or value of items in financial statements is never estimated. True or false? Okay. So most of you have given the correct answer. Correct answer is false. Correct answer is false. Various items in the balance sheet, they are estimated. For example, account receivable. You don't know what is the amount actually you will get, but we are just having an estimate. Any provision for doubtful debt, estimation. Amount of expenditure on electricity which is going to be accounted for and as on 31st March, estimation. So various estimations are there. Last question. What is the most common basis of measurement used in financial statement? Most common measure used is the historical cost. Most common measure is the historical cost. Please remember that. Last question answer is, what is the most common basis for measurement used in financial statement? Answer is historical cost. Historical cost is the original cost of the item which is purchased. So last question answer is historical cost. Last question answer is historical cost. Historical cost means the original cost. So the items which are there in the balance sheet, initially they are at historical cost. Initial measurement is done at historical cost. So what have we learnt in this session? IFRS is a single set of high quality accounting standards issued by IASB, International Accounting Standards Board. IFRS is applicable globally. Over 120 countries have either adopted or converged to IFRS. IFRS sets the recognition, measurement, presentation, disclosure requirement to the elements of financial statements. Advantage is they help in easing the business in globalization, cross-border listing, fundraising, consolidation of foreign subsidiary and global merger. Indian GAAP consists of accounting standards and Ind AS. Ind AS are converged standards issued in line with IFRS, getting applicable from 1st of April 2016. With that, we are coming to a conclusion of today's session, but please don't go away. Please give your feedback. Thank you.